Welcome to the next segment of our video series, The Top 10 Planning Mistakes That Will Keep You From Retiring Well and What You Can Do About Them. I'm RJ Kelly. I'm founder and chief visionary officer of Wealth Legacy Group and the Wealth Legacy family of companies, and I'm delighted that you've made time to join us. We're wrapping up a series on retirement planning and why most Americans simply will not be able to retire well unless they make some major changes in what they're doing. My observations come from over 30 years helping clients as a fee-based, independent registered investment advisor, chartered financial consultant, and retirement income certified professional. Now, in our last session, I spoke about the sobering reality that many individuals are experiencing now, that they have retired and that's that they just simply not saved enough to provide a comfortable income at retirement. There are multiple reasons for this as we've been discussing. And in our last video, I called out the main culprit as individuals not putting their own needs ahead of helping others, especially with their adult children. For these folks struggling in retirement, they're running uphill. They didn't embrace the important life lesson of learning to be sensibly selfish when it came to planning ahead for their own retirement, and when they could truly do something about it. Now, there's a saying, as I mentioned in the last video, that the greatest gift you can leave your children is that of a quality education. And there is a lot of truth to that. I'd also offer this corollary statement that the greatest gift parents can give their children is the gift of parents that can come to visit and never need to stay. Now, in this video, we're going to tackle 3 key points and get a little bit more technical, just a little bit. We're going to discuss a term of art called investment volatility, or I simply like to call it the wiggle, the ups and downs of various investments, particularly stocks and bonds. Investment volatility can wreck even the best retirement plan if it's not been adequately anticipated. So what can you do to tame this beast of volatility and have it work for you and not against you as you prepare for retirement, or perhaps are experiencing it right now if you're in retirement? Now, the second key concept that ties into this as well is called sequence of returns risk. Do you know the 4 most dangerous years to navigate in ensuring a successful retirement? May I tell you? It's the 2 years just before you retire and the 2 years immediately after you retire. Now, why would I say that those are the most dangerous years? Because if the market or the economy tanks, you may either have to postpone retirement, or if you've already begun pulling money out of your accounts that are down by 10 or 20 or 30% or more, you're going to accelerate the collapse of your portfolio. So how can we plan our retirement nest egg so that in the years when certain investments may have turned down, we have alternative sources, other buckets that we can draw from? Now, overall, this will help keep more money for us throughout our retirement. I call this the $1.2 million difference, and I'll look forward to telling you about that in a minute. And along with the discussion of volatility, the wiggle, and sequence of return risk, and the need for multiple buckets to draw from, we'll tuck in a third point on the importance of having one of those buckets provide a tax-free income stream that has downside protection for your principal when the stock market turns UGLY ugly, which it can happen. So we're hearing from many of our new clients a great deal of concern about losing money in their investment or their retirement accounts when the next big downturn in the market hits. Their concern is so much, in fact, that many have reduced their exposure to stocks and real estate significantly. Now, this, in my opinion, is a big, big mistake. The Federal Reserve just announced that they plan to have no more rate increases for the next 9 months, the rest of the year. By the way, this is March of 2019 as a reference point. And they're only projecting 1 more rate increase in all of 2020. Therefore, being too heavily invested in bonds or fixed annuities could be a major blunder. Bonds are designed to be a safety net in the event the market tumbles or a catastrophe happens. Stocks, on the other hand, power your portfolio's growth so that they can prosper over time. Now, you might be saying to yourself, is that really true? How have stocks done over time in the US? And if you guess there's a really great big "it depends" coming, well, you guessed correctly. So let's unpack just how well or how poorly the stock market has done over time. The average individual investor over the last 30 years has seen a return of only 3.66 3.66%. That's almost 1% less than the Barclays U.S. Aggregate Bond Index return of 4.62%. On the other hand, compare that atrocious, measly return to the Standard & Poor's 500 index. That's the 500 largest companies in America. And that had an average return of 6.73% over the same 30 years. That's nearly twice as much as the average investor's return. And a return of 6.73% is very much in keeping with the average return of the stock market since inception, which is 7%. Now, recognize that this 7% has not been a straight line return. This 7% takes into account the highs of the 1950s, which was a truly magnificent decade. Yeah, you probably guessed that I was born in the middle of that one. But anyway, with an average return of just over 19% per year in the 50s, to the lows of the 2000s when the average annualized return was just a whopping 1%. Still, in the last 50 years, the U.S. stock market has had an average return of over 10%. So let's go back to the concept I began with, and that's market volatility, the wiggle. We have seen a great deal more market volatility these last few years. When you couple that wiggle, that increased wiggle, with increasing life expectancy, and we have an earlier video on that topic, and bottom line, you're going to live a whole lot longer than you think. And you add that increased longevity to lifestyle expenses and costs. Well, many portfolio advisors are dropping their recommended withdrawal rate to only 3% of the portfolio per year, or no more than 4%. Yikes. By the way, that's not a technical term. It just sort of came out. Yikes. 3 to 4%, that's it? Now, if instead you can increase your average return on your investments to, say, 6 or 7% by having more equities in the mix, well, you can actually afford to take out 5 or 6% per year from your investments with a back-tested probability of portfolio success of over 96%. Normally, if we have a percentage of over 80%, we're considering it a very, very strong portfolio. But 96%, that's doing good. So with bond yields and total returns in the 2 to 4% range versus an 8 to 10% return from stocks over time, you just simply have to include equities in your portfolio. And yes, even though there will be greater wiggle by including more stocks in the mix, the higher returns over time will be more than making up for that if, and there's a big if here as well, if we can find a way to make the wiggle less, even while we're at the same time including a higher percentage of equities than you might have been originally comfortable with. Now, I hope by now, perhaps a few of you are opening up to the necessity of including a higher percentage of equities in your portfolio, even if you're in your 70s or 80s or even in your 90s. But how do you temper the dreaded portfolio wiggle that comes with adding equities in the portfolio? Unless you do, the wiggle can lead to the very rapid decumulation. We try to accumulate assets, but when we start taking money out, that's what's referred to as decumulation. And with a lot of wiggle, when you're taking money out, you can accelerate the decumulation of your port value long before you've gone to meet your maker. So running out of money while you are still alive is definitely not a good thing. It's going to ruin your day, trust me. Are there sensible methods to addressing this wiggle that are proven to work over time? And the answer is yes. An important step is understanding the simple truth that preserving your portfolio is not as much about what percentage gains you make in the good years of the stock market's returns as in how much you don't lose in the bad years of the market's losses. For example, a portfolio that loses 15% in a particular year has to earn almost 18% just to get back to break even. A 20% loss requires a 25% return to get back to square one, and so forth. The nearly 40% loss of market value in 2008 in the U.S. economy meant that it would take almost a 67% return to get back just to, again, to break even. And if you were already starting to take money out of your portfolio for retirement at that point, the rate of return to get back to that break-even point, well, it just gets you that much bigger again. Now, one clever way that I found that helps tame the wiggle is through an investment platform we've begun using a little bit over a year ago, thanks to a good friend named Lou. It removes the emotion from investing, which is one of the biggest reasons individual investors have only averaged 3.67% over time. It gives greater diversification than just investing in the S&P 500 index. And it also protects the principal when the market inevitably does turn down, at least for a short time. So, okay, another quick trivia question. You've probably heard something called a bear market. So a bear market is defined as a period of time where the stock market goes down by 20% or more from the high point to the subsequent low point. So here's the trivia question. Since 1900, how many times has the stock market in the United States dropped by at least 20% or more? A so-called bear market. Dun, 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 dun. I'll give you the answer. From 1900 to 2018, there have been 33 bear markets. 33. Now think about that. Statistically, that works out to roughly once every 3.5 years. And they last an average of 367 days, so just a few days over a year. So what if we could keep 40 to 70 to even 100% invested in stocks to turbocharge our portfolios, but then put a safety net under those assets so that when they drop by 4% or 7% or 10%, the whole portfolio gets moved out of stocks automatically and goes 100% into cash or bonds, fixed income types of investments, to ride out the storm. Higher returns when the economic sun is shining and it's a quick run to safety when the storms hit. Well, that's possible. In fact, that's what this particular platform does. So much for discussing wiggle and its potentially negative impact on your portfolio, especially when you're already in retirement. Now let's quickly touch on sequence of return or sequence risk, as it's referred to, and as it relates to this conversation and why it matters. Why it matters at all. Now, let's say when you retire or you've retired, you've accumulated $1.5 million in an individual retirement account, in an IRA. At that point, you decide to start taking out $100,000 a year from your $1.5 million. Now, normally I wouldn't recommend taking out that high a percentage, 6.67%, but it just makes the math a little bit easier for our conversation. Let's also assume, for our example, that you begin taking out your withdrawals in 1998 for 20 years. So from 1998 to 2017. At the end of 2017, after taking out $100,000 a year for 20 years, based on actual historical performance, you'd have over $770,000 left in your bucket. So roughly your bucket would be half empty. Now, what if instead you had two buckets to draw from? Not just your IRA, but you had another bucket. So you've got your IRA, and then you've got this backup. And this backup bucket is also invested in equities, but it has a special protective feature so that the rate of return earned can never be negative. So even when in 2008, when the S&P index dropped by nearly 40%, 40, your other bucket would simply credit your account with a 0%. Okay so far? So you've got this downside protection. So we've got two accounts to draw from, not just the one. And we're just going to change one other thing in our example. So in our example, in the first part, we were assuming you'd take out $100,000 of income on January 1st each year. Now, this one of the changes we're going to do is that any year when the returns are negative, when they're minus, the following year, we're going to take that $100,000 from that backup bucket that we've got sitting on the side. Now, in the 20-year period of time from January 1st of 1998 through December 31st of 2017 in our example, there were 4 years when returns were negative. Not bad, 4 out of 20. Now, by not being forced to take income out of your IRA in the years following the negative returns, but instead give it time to recover or start recovering, it makes a huge difference. How much of a difference, you ask? I'm so glad you asked. Would you believe it makes a $1.2 million difference? By not being forced to take income out when an account has already been hammered by that volatility of performance, And having a backup bucket that has principal protection, we can greatly reduce this sequence of returns risk. That's that fancy term. Told you we get there. Now, in this case, we're talking about having almost $2 million left in our IRA at the end of 20 years, not the $770,000. What difference was it? We just didn't take income out following a downturn in the market. Now, there may be somebody out there who picked up that in using an IRA, there are required minimum distributions starting at a certain age at 70.5, and that is true. And in my example, I did have 1 year where we actually had to take out some income to meet that required minimum distribution requirement, even though it followed a down year. But still, even with taking out that $45,000, we still had over $1.2 million more in our account by simply being able to take money from that backup bucket to draw from. So that's what sequence of risk, that's why it's so important for us to understand where our income is going to come from and having a variety of places that we can go to, especially in this idea where we have downside protection without one type of investment account to make up for this other bucket over here that has more volatility. Now, one other quick thing. That backup bucket I described a minute ago that invests in equities but has the downside protection, well, it's actually a hybrid life insurance contract. So it's definitely not like your parents or your grandparents ever bought or mine. So not only do we have the special downside protection of principal when the market drops, but in many states, they allow a certain amount of life insurance cash values to be protected against creditors. We have a number of clients in Texas, and one of the things I love about that state, a variety of different reasons, but we can have $10 million sitting in a life insurance contract, and none of that is subject to creditors' access. Now, this also has properties that make it a much better choice than using a Section 529 plan for education funding as well. And also, importantly, the income that comes out of this is income tax free. Money that goes into it, of course, is after tax, but not only do you get that back, but also the growth, when it's correctly designed, the growth comes out without tax as well. And of course, there's always the tax-free death benefit, although we usually squeeze that face amount down to the smallest amount that IRS allows us to have. But there's still more ultimately coming back than we put into the contract, either as income, death benefit, or both. And last, with many of the newest designs of these really hybrid specialized products, they allow you to tap into the death benefit for a long-term care need under certain conditions. This is tax-free also when it's designed correctly. Now, lots of things to like here. We just don't have time to unpack as fully as I'd like, but we can discuss this further during our complimentary consultation if you have an interest in discussing it more. So, there you have it. The importance of including equities in your portfolio for the rest of your life. The importance of addressing the investment volatility, the wiggle, and ideas on how to control it. And remember, it's not how much you make in the good years that's as important as what you don't lose in the down years. We also touched on sequence of return risk and why having multiple buckets to draw from is so important, and even better if that income stream can also be income tax free. Hopefully this prompted some more questions for you, so we invite you to write us, email us with your questions. The address and our website are both shown below. And if you'd rather get some quicker answers, just call us on our 800 number. The call is free, the consultation is free, and we can discuss your unique situation. Let's talk about what you're concerned about, what you have in place already, and where the gaps might be. And I'll tell you what I think, what you're doing, and if there's anything I feel that you could be doing to improve your plan and make it better. Regardless of your preference, just don't put it off. Your financial future is at stake, and let's get it built on the most solid of footing. To wrap it up, in the next segment, we're going to talk about something much less technical, but still extremely important to living a long and satisfying retirement. And that's the importance of being socially and physically active after you retire. Those who don't have a life plan for after retirement face the very real probability of dying far too soon. And dying too soon can truly mess up having a great retirement. It might make a great retirement for somebody else with your money, but not so good for you. So let's talk about how to make sure that you're around to enjoy every dollar that you have coming to you, shall we? So why not make that call? It's free, so is the consultation. Let's talk about what you've got in place, and together we'll help you build the most amazing plan for retirement. I'm RJ Kelly. Let's get started planning for your ideal tomorrows today.